Zach's Corner, April 2022. John Graham, Director of Strategic Sales for BM2 Freight, with Zac Rogers, Associate Professor of Supply Chain Management at Colorado State University, where we discuss the latest insights and trends based off of the latest Logistics Managers Index. If you don't know, well, this is it. If you've just heard it now, well, lucky you. Zac, why don't you kick us off with the latest and greatest? What are we seeing out there in the marketplace? A lot of change, a lot of opportunity. Let's hypothesize what's
Well,
happening.
I'm happy to be talking to you. I know you're live from BM2 headquarters down there in Kentucky. So thanks for for going across time zones to do this one for me. So the April Logistics Managers Index, for those of you who are not familiar with the Logistics Managers Index, a lot of you this would be a repeat. But the Logistics Managers Index is a change index, a diffusion index that I put together every month with colleagues from Arizona State University, University of Nevada, which are my two alma maters, by the way, Rutgers University, and then the Rochester Institute of Technology. And you're looking at the crux of the survey right here. There's of course, some demographic stuff, some future predictions we pick up, but this is what we ask. We say, hey, inventory levels, costs, warehousing and transportation capacity, utilization, and prices. Are they staying the same this month? Are they down from last month, or are they up from last month? That's all we ask. We use that to create a diffusion index. And that diffusion index, essentially, everything above 50 means growth. The further above 50 it is, the higher our rate of growth. The lower, if it's ever lower 50, below 50, that means we have contraction. The further below 50 it is, greater rate of contraction. You can see the overall index, which I put here for the last 2 years. So April 2020 to April 2022. And in some ways, it's kind of nice that we're doing this in April, because there's sort of bookends a little bit to what has been the most madcap freight market probably of my life, certainly that I can remember. Because you see, April 2020, we had a 51. That was our overall reading. And you all remember April 2020, John. We were inside. We were learning how to make bread.
Amnesia. I don't know what you're talking about.
That didn't happen. We were watching weird stuff on Netflix. I mean, you're looking for anything to do, and we're at 51. It's the lowest the index has ever been. Was this month 2 years ago? 51, closest we ever got to contraction. Never got to contraction, by the way, because even though transportation was down, warehouses were just bursting with inventory at the time because everything had just stopped. We had a lot of spring clothing that went unsold in 2020. Go forward, you can see we've been in the 60s a couple times, but mostly since September of 2020, so last year and a half, we've been up in the 70s. We dipped down in January and December 20 and 21 because of inventory issues, but pretty much we've been in the 70s, which we classify as a high rate of growth for the last year and a half. Well, that changed in April of 2020. We dipped down to a 69.7, still high, by the way. The overall average rate of growth for the index is about a 63 over the last 6 years, which is how long we've been doing it. So this is still greater than average rate of growth. It's just that it's not the fast rate of growth that we've been seeing. And there's a couple reasons for that we should talk about today. So the first thing I want to show everybody is this price, and I used it I made it using EIA data. So data about diesel and then regular retail prices per gallon. As much as it feels like, I don't know, John, I know you're driving around. You came up here to Fort Collins last week to go on a brewery distribution tour with the students because, education matters. And in
I'll
Colorado,
do it again.
Yeah, exactly. And in Colorado, you're going to teach manufacturing. You're going to go to a brewery. And so John came all the way up here, and I'm sure you had to fill your car up, John. And I bet it wasn't that cheap, was it?
Honestly, I had some gas in the tank, and unfortunately, the tank is massive, right? 20 gallons.
Yep.
So only going up to 80 miles, I didn't utilize the whole thing, but I know it's going to be really painful when I have to replace it.
Mm-hmm. Oh, absolutely. We were down in Denver this weekend. We took our daughter to a dance competition. When I came back up, I had to refill it. And, we're looking at $80. 80,
yeah,
85.
Exactly.
And as much as that's hitting us, as
In
much as
addition to the
uh,
costume and all the other things that you,
there was plenty of pain points. I love watching her dance.
lots of data.
85 other kids, I take it or leave it. But anyway,
Zach's Corner, the dance version. Dance Dad.
that's gonna be the finale. So anyway, for us, okay, a lot of people are feeling that pressure at the gas pump. Our gas, regular retail gas, has gone up 25% since the beginning of the year. That's a huge margin, obviously. Diesel is up 43%. So almost double. Like the pressures that we're feeling, imagine what everyone out in a Class 8 truck is feeling with diesel. And I think it's interesting. Normally, the spread between diesel and gas is about a quarter. You go down the highway and you see the truck stops, about a quarter difference between regular retail gas and diesel. In the last week of April, it was like $1. It was 95 cents for on average. When I was going down to Denver on Saturday, I looked up at the Love's truck stop, and I think national average is 520. I saw 583 on my way down to Denver this weekend, and so prices are spiking like crazy. Interesting.
Well, and really the question for me, right? You look at this chart, which is really interesting because it gives you the dichotomy of the two different struggles between the two different types of users or of this fuel, right? So one, right, diesel, right, freight market. Well, we have the fuel surcharge charts or, pass-through costs. Well, those pass-through costs, depending on the carrier's own internal structure, right? If they are buying in, a consortium where they're getting, leveraged fuel costs, but also what they're paying the driver per mile, right? That could really vary based on, that carrier's, structure, right? And obviously it could affect or drastically affect their ability to be profitable, right? Now, then you look at the freight market and you say retail, okay, I spent $80. I'm used to spending $40 on a tank of gas. Well, that $40 I would use to, buy pizza on Friday nights for my kids, or, hey, how does that affect consumer spending, right? Because obviously the consumer spending, as we all know, as we hypothesize, when we see this normalization back in the freight markets, how are they aligned and are we trending towards the apocalypse, right?
So no, I don't think we are. Here's what's interesting.
That's great.
So consumer spending
That's a bold
actually
prediction I
up.
don't want to see realized.
Exactly. So consumer spending was actually up in March, and it was even up at sort of the end of March and beginning of April. So consumer spending did take a hit, right? Sort of when the Ukraine invasion happens, consumer spending dips down a little bit. Then we actually saw it grow, I think 0.7% when you adjust for inflation, and seasonality rather. It grows 0.7% in March. So consumer spending is growing. Now, is it growing as fast as it was in March 2021? No. We don't have stimulus checks in our pockets. We don't have, all this pent up demand that we had last year. We're going back to normalization, but the thing to remember about normalization is it's still growth. It's just a slower rate of growth. So instead of being on the rocket ship that we've been on for the last 18 months, now we're sort of going back to what I think could be sort of slow and steady economic growth. Now we'll see, right? We just saw GDP for Q1 was down a little bit. You get 2 quarters of GDP going down, and that makes a recession. So we'll see if we get into a recession or not. What is clear though is we are getting into a slowdown. You can see that I have some other data up here. Spot load requests, okay? Spot load requests were down 45% in March and April, okay? Here's why that's important. So the spot market was so crazy. We had, 25% tender rejection index because all of our contracted loads were totally used up, right? Our contract volume wasn't able to cover the increased demand that we were seeing because, like you're saying, because the consumer and catching up. Now that we do have some slowdown, we're not using the spot market nearly as much. Now, we should point out spot rates, even though they're down a little bit for dry van, are still up 10% from a year ago. It's just slowed down. And then contract rates are falling too, although slow, right? So because contracts go a little longer, you never see them, right? Spot market, is like, I mean, that's like a bouncy ball. That's just all over the place. You know, it reacts to everything. Contract rate's going to react a little bit slower. And so we do see both of those coming down, but you're feeling it more keenly on the spot side, especially for dry van. Flatbed actually is up, interestingly, but you're seeing it on dry van because now our contracts are absorbing more of this volume than they were over the last year.
Well, we're probably going to see, because of reduced bottlenecks out there, right? Where we were solving supply chain issues with transportation, right? And that's really kind of what fueled kind of that rising spot market, because these were not normal routes, right?
Mhm.
Or they were falling above potential like rail lanes, or we had bottlenecks at the port, right? So we were transloading product in ports. So we're seeing like some unnormalized activity. So now we're seeing like maybe some of these bottlenecks are going to start to slow down, right? We're going to see some more normalization, but also with the reduced bottlenecks, we're probably going to see some more industrial activity start to replace there, because we're getting those raw materials or those products in to backfill, right, potential orders at a higher velocity, right? So depending on, some of those indexes, but I think the end is like in transportation, logistics, and supply chain, everybody's job's going to get a little bit easier. And when I say that is because we reduce bottlenecks, we're not going to have to solve problems with transportation, which obviously throws costs into the equation, unfortunately. But some of this balancing out, I think, is going to be healthy. But again, if we're profiting or building your business model on the increase in freight or running spot boards, obviously it's time to really think about the future and um, and look at it accordingly, right? Spot market was super inflated. It needs to come down. Historically, backhaul rates, which is this the spot market, which was a huge value add, and still will be once it kind of surpasses your contractor rates. In 2019, I was advising my outsource clients, hey, we should put more freight into the spot market so you can save money, right? So we can help your bottom line on your freight budget. Now, there are operational considerations for all freight, right, that may or may not be good for all organizations, depending on that. And some organizations say we really don't want to play market pricing, but again, there's opportunities for an advantage there. But I think you had a chart there where really kind of illustrated the
movement. Yeah. So, and I'm going to get to that. One thing I do want to say, and I'll flip over the chart as while we talk about it. The component thing, you're right for most components. Now, if it's components or commodities coming from China, I wouldn't expect those to show up. That's
Put a hold on that.
They really shut everything down at about April 6th. So if you play that forward, 30 days maybe across the ocean, and depending on congestion, maybe it's 40, 45. We're going to see the real impact of the Chinese shutdowns in American ports this month in May. That's where we'll really see that spike up. So there's certain things, battery components, things like that, where we're not going to have it. The second thing you said, though, about rebalancing, I totally agree with. Part of that is because we worked through this bubble. We just had lines and lines of people in Southern California taking things out and then going straight back to California, regardless of the backhaul, essentially, right? And so what that did was it got all of the freight out of position. And so it became really tough to say, I want to send something from Denver to Cincinnati, right, where we are now. That was a hard truck to find, that Denver to Cincinnati truck, because everybody was running back to Los Angeles. And so by getting through that congestion, now we're spreading the ball around a little bit more. We're not just looking at one lane like crazy. So this, I think, is informative. So this graph, which I put in the maroon and gold of Arizona State, go Devils. I put in maroon and gold, my alma mater, and the maroon line is available capacity. The gold line is transportation price or transportation, right? So if we look at it, and this is going back to September 2016, the first month we started the logistics index, you can really see the story of the economy. And by the way, the cyclical nature of freight in this graph right here. The fact that it's boom, bust, we know that, I think, intuitively, but here it is empirically. So if we look at the inversions of the red line and the yellow line, okay, anytime those lines cross, that means something happened economically, and probably we're having a freight recession, okay? So if we look back, all right, 2018, huge spread, prices are really high, capacity is really low. That was right after the tax cut, since January of 2018, the tax cut goes in, everything goes crazy in the economy. We build up a lot of extra capacity. And then you can see around early 2019, kind of the party was over and it was who gets stuck with the check. And we had, between 2019 and 2020, 3,000 small carriers closed. And we see a period of about a year where capacity is higher than transportation price. And I'm sure everybody remembers how 2019 was. And then we see a really weird thing happens when COVID breaks out, where prices spike. And that was, oh my gosh, we all need toilet paper, basically, that 1 month spike. Then it goes back down. We invert again for another 2 or 3 months. Again, everyone's sitting at home, except John. He doesn't remember it. That never happened. He time traveled forward to July.
You did homeschool. That never happened.
Oh my God. I know. I thought my job was hard, but listening to my kids' teacher being like, okay, does everyone know where the mute button is? And none of them knew where the mute button was. They're 7. That was like that's really a hard job. But so anyway, we go forward to July, we see an inversion again. And now we're in the period of like, let's catch up. Let's catch up to where we were. And that's the rocket ship. Look at how price spikes up and how capacity spikes down between spring and fall, basically. Like March, April, really April was the nadir. April to September of 2020, totally different world. And we've been living in that totally different world for the last year and a half. We've had huge spreads. I highlighted April a year ago when we had a 92 level of growth in price, at 33 in rate of contraction capacity, 60 points apart a year ago. Come forward now, and you can really see a lot of the movement. A lot of the movement has happened in the last 2 months. In fact, that reading on the maroon line of 56.9 for capacity, that's the first time we've seen growth in capacity since June of 2020. So it was more than a year and a half since we saw trucks, supply outstripping demand month over month. Because that happens, prices come down. Now, here's what I'll point out. The lines haven't inverted yet. If the lines invert, that probably means we're going towards some sort of freight pullback, right? Some sort of recession, essentially, in the freight market. Now, not bad for the shippers necessarily, because now we can get trucks for everything, but it'll be
at a competitive rate.
Exactly. Now, we haven't seen that yet, and I don't know that we will. I'm not confident that it is going to be a big, prices are really, really falling hard. And the reason for that is, one, like we said earlier, consumer demand is still strong, okay? And this could be, not necessarily we're going towards a recession, although maybe we will, who knows. But it could also be that we're going back towards balance. We're going back towards equilibrium in the freight market, right? We've been going, it's like we've been driving 100 miles an hour down the highway. That's not sustainable. Eventually, you got to slow down. You got to do 75 miles an hour. 75 is still pretty fast. It's not 100, but it's also we're going to get wherever we need to go. I think if you compare this to where we were in 2019, that was more like we were driving 75 to start with, and then we slowed down to 50, right? And you shouldn't be driving 50 on the highway, probably. I mean, the highways around here, I-25 around 5 o'clock, yes. But mostly no. And so that's where I think we are. And when I say there's a recession, by the way, here's to that effects is the small carriers, right? The little fleets, they can't get diesel at a wholesale price, probably. And also a lot of the newer ones, they're sort of, if you're a Johnny come lately, if in the last 9 months you thought, man, the freight market's crazy, I'm going to go buy a truck, you probably paid a lot for that truck. Your costs have been high, and maybe you haven't had to be incredibly strategic about loads because all the loads have just been coming to you, right, for the last 18 months. And now that's going to change. And some of the big carriers, the loads that were, beneath them, right, when a year ago when the tender rejection index was 25%, well, now it's 10%. So instead of, I can, every 1 out of 4 loads is below me. Now it's 1 out of 10.
Well,
And so we have
it's,
people
it's
who
kind of a
loads it
false
when it's
positive
84.
too, right? I mean, with the prices being up,
Mhm.
people were rejecting at that, 2019 rate, where, things were taking time to catch up to a, current market rates, if you will. So what we're going to see from a rating game this year, we're going to see a lot of rate adjustments
Yeah.
accordingly, right? That are going to probably be in line because, well, let's be honest, right? They were probably a little inflated. If you're a carrier operating in the
Yeah.
last year and a half and you weren't profitable, you probably should just find something else to do because, obviously, it was a very booming time. But there are opportunities again for repositioning out there just because there is so much tonnage available. It's just part of our industry, right? To 850,000, give or take, of motor carriers for hire out there, right? We saw a big, trend towards that, the 1 in 5 owner operator versus your, kind of 2,000 truck, carrier fleet, right? And and then obviously a large percentage in there, but it was already really heavily weighted towards that smaller, fleet size. That 1 to 5 was about 85% of the total market, and that's obviously gone up. So unfortunately, we'll probably see, some of that spot market price is going to probably drop off sharply. I think I heard or read something this morning. It's definitely going to drop off sharper. And unfortunately, we'll probably see a rash of bankruptcies as a result. But at the same time, things will, as they start to normal out, and there's opportunities for both carriers and shippers still, to do, to make good business relationships out there. So I don't think we're in an unhealthy situation. There's definitely change, and that's why we look at Logistics Manager Index. So we're getting ahead of the curve, if you will, so we can avoid the apocalyptic situation.
Well, and what happened? And what happened last time that all of the volume from China fell off? We had to catch up, right?
Yeah.
And so I wouldn't be surprised if we get to the end of the summer. Now there could be a big slowdown at the dock because, by the way, dock worker contract is over on July 1st. So you think those guys have spent the last 2 years thinking they need a pay raise? Because I actually do.
Yeah.
And so we'll see what happens. But we're going to certainly have a lot more freight coming in the fall.
Yeah.
And
Q4 is probably going to be a bloodbath.
Yeah. So I think we're going to stay on the roller coaster for a little bit longer, in some ways.
I agree.
Here's the other thing that's important, by the way. Here's the other thing that's different about now versus the last time these curves inverted. So we spent the whole time talking about transportation. In the Logistics Managers Index, we also look at warehousing and inventory. and we put them together. We put all of our cost metrics, our 3 cost metrics, inventory, warehousing, and price, or in transportation, together into this aggregate price chart. So it's 3 metrics together. So it goes from 0 to 300, right? Because it's 0 to 100 metrics. And look, a year ago or 2 years ago, we were at like 150, right? We were right at like, we're almost on the borderline contraction. Last month, so March, and we said this in the report last month, we think we've hit the top. 271, we're probably at the mountaintop. Now we're coming back down because there's honestly not much room to go up to 271. And now we're to 247. That's almost totally driven by transportation. Warehousing prices and inventory costs both grew at levels in the high 80s, mid to high 80s this month, because we still have a ton of inventory left over from the congestion we had in the ports, right? Everyone way over ordered. It got here late. We've got all this inventory buildup, and it's really hitting us downstream with retailers. Retailers have way too much inventory, and there's a bunch upstream in warehouses and distribution centers and stuff. And so unlike last time China shut down, we're not shutting down here. There will be the movie The Purge, that will happen before we put masks back on and go back inside to watch Tiger King. Like that. There's no chance. There's no chance that that's happening in the United States.
The sequel.
Yeah, there's no chance. And so we're going to keep spending this summer. Now, one of the other differences is we're not stuck inside. So we're not like, well, I guess I'll remodel the house or whatever. Now we're like, well, I'll go to a baseball game. I'll go to Arizona. I'll see my parents. There's service industry stuff now we'll be spending money on. And also the goods that are already here, those are going to get bought up. And so I think we have more of a buffer in terms of both goods, consumer sentiment, spending than we did in 2020 when we saw this fall out. So I don't think it's going to be like spring of 2020 when suddenly the legs were cut out of every market. There's still stuff.
We were in such a just-in-time model in the supply chain because we could be super efficient, and it would look good on a balance sheet because the inventory costs were low and warehouse footprints were low, right? So, I mean, of course we were trending there because we're all smart people and trying to create efficiency within our network using best-in-class supply chain practices. However, we probably overlooked that danger signs in 2013 when someone was like, "Hey, what happens if if a pandemic hits? Are we at risk?"
There's a tsunami in Japan, which, by the way, it's not a coincidence that Toyota is the only automaker with a ton of semiconductors because they went once already, right? Toyota.
Oh, we'll deal with it if it happens.
Yeah, the poster
No,
child in time is just in case, and it's going to be just in case to the rescue in the freight market for I think at least the next couple months. So the last thing we should do here, it's always our last slide, is future predictions.
Bold predictions.
Bold predictions from our respondent base, and our respondent base is usually pretty good. That's what happens when you ask, a couple hundred really smart people what's going to happen, and you average out the answers. They turn out to be pretty good. So that's what we got here, and it's interesting. So transportation capacity is at a 62. So we're expecting a pretty healthy rate of growth in transportation capacity for the next 12 months. Now, that number, like we said, had been negative for like a year and a half. Not on this graph, though, not on the future prediction graph. Our respondents have actually been predicting that capacity was going to come online for the last 6 months. So now we're actually kind of seeing, I bet if we went back, they start predicting more capacity right around last fall. So we're not far off from when we started to think capacity was going to start coming on. So, because basically last fall they said, oh, in the next 12 months, some will come on. There it is. There's that new capacity they're predicting. Now, it came on a little faster than they thought, I would imagine, because of the slowdown we've been in. And it's interesting to see all of those transportation metrics are now in the 60s. All of those 62, 66, 68, that's all moderate, steady growth. And right around the averages, especially pre-pandemic averages, for where that stuff should be. Warehousing and inventory still looks exactly like it's looked all through 2022. Inventory growth, significant inventory growth, 73, leading to significant inventory costs. And because we have so much inventory, warehousing capacity is expected to continue contracting because it's difficult to bring that on. And warehousing prices will continue to grow. And so this is where we are in terms of the overall logistics industry. Transportation seems to be moving back towards normal. And that's to be expected because transportation, like we were talking about spot markets, that's the most reactive, right? Transportation prices can change from a day to tomorrow. Warehousing, you got a long contract. Inventory doesn't just disappear or reappear when you need it. And so transportation is going back to normal. Warehousing and inventory are sort of staying in this post-pandemic catch-up mode that we've been in for the last year and a half. And it will be interesting to see sort of where these all go in the next month, especially as we really start to see the effects of the Chinese shutdowns at U.S. ports.
I got a bold prediction.
All right.
Zac's Corner is live and well, and it's going to be coming at you from here until forever.
Exactly. Exactly. If anybody, by the way, is interested in more information about everything we've been talking about, new online reports are out on the first Tuesday of every month, which was yesterday at the time we're recording this. I'm sure you got to go put in a bunch of special effects and CGI our faces up. So maybe this comes out in a week. But if you want to check them out, we're at the-lmi.com. You can see the last 2 years of our reports. I think are up for public, and so please go ahead, check it out. If you're interested in being a respondent with us, like we said, more smart people giving more smart opinions make us look better. So if you have a bunch of good insights, freight market, something like that, you want to be part of our mailing list, shoot me a note. I'll be happy to add you and talk to you about becoming a contributor.
Thanks, everybody.